In this video, I'm going to be showing you and telling you and educating you on everything about a self-managed super fund or an SMSF so that you can easily make the decision on whether it's a good or a bad option for you moving forward. So I'll kick off why set up an SMSF. It really is in the name of the entity. It's to set up a fund, a super fund, where you can manage it yourself. So you've got full independence, you've got no one else managing your super, you get to make all the decisions and ultimately control how much money you have in retirement. That's the true why, that's the true reason to setting up a self-managed super fund. The benefits of setting up a self-managed super fund, you can see, are on these outliers here. And these benefits are around having full flexibility in what you invest in, having reduced tax because a super pays tax at 15%, an SMSF pays the same tax, you personally pay up to 50% tax, and an SMSF which can move from super to pension phase pays zero tax once you're over 60. So having flexibility on manoeuvring money from business or personal into a self-managed super fund which you have flexibility on decision making is a big way to get out of the tax man. Third, you can run family protection and family insurances through an SMSF. In particular, life insurance, disability insurance, and income protection. And when you run these insurances through an SMSF, you as the trustee get to make the decision on payout if the insurance company pays because some life event happened that was negative that required a payout to you or your family. And finally, it's just to have more wealth in retirement, and SMSF gives you the flexibility to determine what's in your best interest in terms of investment to get you to that required dollar amount when you hit 60, 65 years of age. So how do you do this? How do you set one of these SMSFs up? How do you get it done? What do you need to consider when setting one up? I want to go through all of that right now as well. There's three main key components of an SMSF that you need to be super mindful of to start with. The first is you need to know that there's accounting and tax requirements each year. You need to know that you need to set the legal entity up to begin with. You need to know that there's audit requirements each year. So you've got to have a checklist ticked off that you're remaining compliant. And also you need essentially a financial plan. So you need a financial plan that goes with the SMSF that says that ultimately outlines what you should be invested in. What investments, whether it's shares, managed funds, property, the different components or percentages of those assets, how much is sitting in cash. You need a financial plan as well. So once you've got an accountant or a financial planner that does these respective components, then what you need to know is the basics of how you can set one up, or I suppose what makes you eligible, I should say, to set one up. And this will usually be around your balance that you have in your respective supers currently. First, you'll need a minimum combined balance between you and your partner of at least 200 to 250,000 before you can even consider setting up a self-managed super fund and getting a financial plan that pertains to that SMSF. You need members of the SMSF, so you need at least 1, 2, 3, 4 members in the SMSF to set one up. You need to really have an accountant and a financial planner or someone that can get this structure set up for you because it is just way too complex to get set up by yourself. You need to have an understanding of what you truly want to invest in, like what you believe is a good investment. Is it property? Is it shares? Is it managed funds? Are you educated on these different assets? But really the key thing you need to know is the minimum balance to get one of these funds set up. And then once you've got those kind of key numbers, then we can move towards liaising with a professional that can get this stuff set up and get these investments set up as well. So what I'd suggest you do with determining whether it's right or it's wrong for you is definitely speak with a professional. Speak with your current accountant, speak with your current financial planner, do a little bit of your own research, but make sure you keep it as simple as you can when you're doing this research, because it's easy to get lost in just an abundance of information that's on the net right now. Also, feel free to send us some comments to this video being put on social media that just ask for more clarity. Like, I'm happy to, my team are happy to jump on a call, we're happy to send you an email with more information, but I would definitely say don't write off an SMSF until you understand it and how it operates, because when you've got a professional backing you, they become quite easy. So I'll leave it there for today. Like I said, the key thing to have a good, strong SMSF setup is 3 key principles, and that's having a good financial planner, a good accountant, and a good auditor. At Strategic, we can do all 3, but yeah, I will definitely make sure you tick those boxes, and then you'll have the benefits on the outskirts of the model. Talk soon.